Now, even investors with a solid investment philosophy and asset allocation, and this comes back to the behavior stuff we mentioned earlier, they still often get nervous about market corrections. And they'll consider maybe going to cash to avoid the correction or delaying investing new cash until after the crash has happened. I see that a lot. So fund manager Peter Lynch said far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. I love that quote. It reminds us that while market downturns can hurt, and they for sure do hurt in the short run, the opportunity cost of not investing is typically far more expensive.
This one is absolutely true and really insightful. One of the things that I've always liked to say to clients, because every now and then you will hear them say, I've got some cash, but I'm going to wait until it feels like a better time to invest. I'm going to stop you right there. It never feels like a good time to put a big chunk of cash into the market, because if the market is strong, then you're going to fear it's got to come back to earth, right? This can't last forever. And if the market is weak, you will convince yourself that it's going to get weaker. I've seen this so many times that I have lost count. And so I say to people, like, if all you can bring yourself to do is dollar cost average, then do it. It's imperfect, but it's not a bad situation. And if it prevents paralysis, then it's a very good strategy. But if you think that you are suddenly going to feel great about putting a large amount of cash into the stock market, yeah, zero chance of that happening.
Yep. I've said before that if you feel really good about an investment, it's probably not a good investment.
I think that's good advice.
You're probably about to get scammed, or you're about to invest in something that has a low expected return. That's the thing, right? Like investing is inherently risky. And it is that fact that results in positive expected returns. And historically, at least, it has resulted in positive realized long-term returns. But the problem is that investors are myopic. They worry about short-term fluctuations, even if they are themselves not short-term investors, and they're loss averse. You get myopic loss aversion, which makes it hard for investors to take a long-term view. Economist Jeremy Siegel, who wrote Stocks for the Long Run, he said, fear has a greater grasp on human action than does the impressive weight of historical evidence. I love that one. I'm probably going to say about all these quotes, but I love that one because I can tell you, as I've done in many episodes, over and over and over, what the historical data tell us about market crashes and recoveries, but that's not going to be helpful when there's, fear in the air. And I think investors need to mentally prepare for those bad times, for those fearful times, and they need to your point earlier, Dan, they need to hold assets that they're not going to panic sell, even when things are not working out as they had expected. And I think a big part of that is that market declines are never abstract numbers on a screen. You don't just look at your account and say, oh, it's down 20%. Huh, would you look at that? There are these psychologically challenging times that stem from deeply emotional and uncertain events. Like the COVID-19 pandemic wasn't just a market decline. It was potentially the end of life as we knew it. I remember it because it was wild. The great financial crisis was similar. It seemed like it was the end of the financial system as we knew it. Everything was falling apart. Society was potentially falling apart. Like it's crazy stuff like that. People were worried about civil unrest because of all of the asset price declines. So it's never just like, the market came down. It's the scary thing happening. I think narratives like that cause many investors to get out of the market in anticipation of worse things to come. But we know, and this comes back to Siegel's point, we know from the historical data that long-term investors, even those who endure, and I might even go as far as saying especially those who endure, market declines tend to be rewarded with positive long-term returns. So I think that's it. I mean, one of the reasons that investors struggle to stick with risky investments is that they don't really understand risk. So I've got some good quotes on that.
Yeah, the one thing I would add to this, and I don't for a second mean to suggest that that's coming through in the quote or in any of the commentary, but I do feel that some people, whether they're advisors or market commentators, tend to be a bit too dismissive of that fear. Like we all understand that, yes, markets will come back, or historically markets have always come back. But, when you're dealing with people who have genuine anxiety about putting their life savings at risk. I mean, certainly we as an advisor have to take that really seriously and can't wave our hands and say, "Oh, the market will come back. Don't worry about it." Right? And I feel that often people are too dismissive of the conservative nature of some investors, and then it's really important for us to say, "Listen, I get it. You know, I was afraid during COVID. I was afraid during the 0809 crisis too, and there's nothing wrong with that." The only thing that's wrong is if you don't match that risk tolerance that you have with your portfolio, right? If you feel that way, but you're still 90 or 100% stocks, that's a problem. But as long as you understand that in yourself and you say, look, I get it intellectually that everything you said makes sense, but I'm terrified of the market all the time, then it's not only okay, it's essential for you to reduce your allocation to risky assets.
Yeah, I think that's true. I remember we talked about this in a previous episode, but I remember Jordan Tarasoff had those client cases where he had a similar difficult conversation where the client was very, very concerned. And Jordan found that keeping them in their current asset allocation as opposed to making it more conservative would add more lifetime value to their financial plan than any financial planning strategy that he could come up with. Because he had had that asset allocation conversation and then subsequently had done a bunch of financial planning work around some other decisions they were making. And he kind of noticed that all of these other strategies that he was looking at, tax-related strategies and withdrawal sequence strategies and things like that, none of them could add as much expected lifetime value as maintaining their asset allocation. So yeah, but I remember Ken French, when we had him on, he talked about exactly what you just said, Dan, that you learn about a lot about yourself in a market decline. And if you learn that you can't handle as much volatility or downside risk as you thought, and you're really uncomfortable, that can be a great, even though, everyone says, well, you shouldn't change your asset allocation when a market downturn happens. Ken French said, I don't think that's right. You shouldn't try to time the market. But if you learn about yourself and realize that you were in a portfolio that was too aggressive, it's actually a great time to make a change.
Yep, I agree. And then of course, you need to make a note of that, because then when the market recovers, no, because people they'll come back and they say, you know what, I'm more comfortable with it now. Let's go back up to 70, 80% stocks. Like, nope, right? Like as an advisor, that's where I would push back and say, no, I agree with the decision to go down because you demonstrated you don't have that risk tolerance, but we're not going back up now, right? Because now we're just playing the game. And but the analogy I like to use is, if people are afraid of flying, you can say to them, statistically, flying is extremely safe. In fact, it's more safe than driving a car, and it will get you where you're going faster. That has zero resonance with anyone who's genuinely afraid of flying, and you just have to respect that.
Yeah. Yeah. On this topic, and a bit of a tangent here, Dan, but we had a conversation with not a software provider, an intellectual property provider, maybe is the best way to describe them, but for a new risk profiling process that I think could be really, really interesting for PWL. So that's something I mentioned that on the podcast because one of the co-founders will, assuming things progress the way that I think that they will and should, the co-founder of that company will come on to talk about risk profiling and their academic work on that topic, and then we'll talk about this tool that we're looking at. But
Great.
Should give us more precision around estimating what people's actual risk tolerances are. Now, we're talking about risk as volatility, which is how risk is often discussed, or maybe the magnitude of short-term declines in asset values. And I think that's how people tend to think about risk. That's how most, like even academic papers, they talk about volatility as risk, or maybe as downside. I think regulators look at volatility as risk and as downside. But those are probably not the best measures of risk for long-term investors, which makes this weird tension between kind of regulation, behavior, and what's actually best for long-term investors. Now, there are some really great alternative definitions of risk that I think can help people think through long-term decision-making as opposed to getting caught up in volatility and downside. So Charles Ellis, who's been on this podcast, he wrote Winning the Loser's Game. He said risk is not having the money you need when you need it. Such a simple definition, but it captures the fact that risk can either manifest as the inability to fund short-term liquidity needs, which highlights the importance of planning for near-term expenses. For example, not investing money you need tomorrow to pay your rent or whatever. Or Risk can manifest as the inability to fund long-term consumption, which captures the importance of saving and earning sufficient long-term returns to fund your inflation-adjusted spending in the distant future. I like that definition because it really captures both of those things in one simple sentence.
Yeah, it is interesting how often risk and volatility get conflated as though they're the same thing. And
right.
you know, that's Ellis's quote really hits on it, right? You have a portfolio that's 100% GICs. Well, there's no volatility. Is that risk-free? Of course not. Right?
Right.
There's all kinds of risks inherent in a portfolio that conservative and that illiquid,
Yep.
but it isn't captured in, even risk tolerance questionnaires and things.
Exactly. Yeah. So I like that quote. Then William Bernstein, who's the author of multiple books, on also actually a past guest in this podcast. He makes the second point from what I just said about Ellis's quote in this definition, where he defines long-term risk, specifically long-term risk, as the probability of running out of money over the decades. Which, to your point about GICs, Dan, you probably have depending on your spending rate, I guess, but you probably have a higher probability of running out of money in a portfolio of GICs than you do in a portfolio of stocks and bonds or stocks and GICs. So Bernstein's separating long-term risk, which I would say is what really matters to long-term investors, from short-term risk, which is less impactful in the long run, but it's also the thing that gives investors sleepless nights. So I think that contrast between the two types of risk and how they can affect long-term decisions is really important. And I like how these quotes highlight it. Now, the tricky thing about this, or the funny thing about it, is that aversion to the short-term risk, to volatility and downside, likely exposes investors to more extreme long-term risk, like my GIC example just now. It's taking on the risk of more volatile, risky assets with higher expected returns that allows investors to expect the higher long-term returns. So Morgan Housel has another past guest. Wow. He's got a great quote on this. He says, "Volatility is the price of admission for higher expected returns."
Yeah, it's nicely said. I mean, I think it's right there. We've said it before, right? The reason that stocks have high expected returns is specifically because they are so volatile. If they weren't so volatile, the returns would not be as high. I mean, it's
Right.
very simple, but difficult for people to kind of really take to heart. The one I've got here is sort of along the same lines, and the quote is from Ken Fisher. This is from his book, Debunkery. The quote is, "Normal annual returns are extreme. It is hard to get people to accept the degree to which that is true." And I think it need to unpack it here. The context of what he means here is, and I've used this quote when I do talks and things like that, and I speak to audiences and I say, so to set it up, the numbers that he uses in the book are the average annual return on U.S. stocks. And this is an arithmetic average, I think, but from 1926 through 2009 was 11.7%. So I said, okay, let's say let's round it down to 11. And if we say that normal is somewhere between 10 and 12 in that range, what number of times in the 84 years in that sample was the annual return on stocks somewhere between 10 and 12%? And no one gets this right, because people say, I don't know, a third, a half. If they're really pessimistic, they say a quarter. The answer is 5 times. There was 5 calendar years in that period where stocks were between 10 and 12%. And most other years, they were more than 20 up or losses of more than 10. So that's the volatility we're talking about. And that's why it's so important to stay invested, right? Because if you get out at the wrong time and you miss the double-digit gains, it's not like you missed the 10 or 11% return. You might miss 25 or 30 on the rebound. And so I don't think anybody truly appreciates, well, you sometimes will hear investors say things, right? Like, I want a kind of slow and steady return from stocks. I said, well, you will never, ever get that, right? You will most likely get a very good long-term return. It will not be slow and it will not be steady. So I don't think people truly appreciate the extent of that volatility. And that's why I love that quote and those numbers. I find them shocking every time I read them.
And it might suck for long periods of time. Like we said earlier that it can be easy to bail on a strategy because it sucks for a while. But like you look at U.S. stocks that had a lost decade of returns. That was a lost decade of returns. That's 10 years. Like,
Yeah, and along the way, like even if it was a lost decade, right? Like let's say it was a zero return over 10 years. It wasn't like, well, it was up one and then down one and
right.
up two and down two. It was like up 20, down 30, right?
Yeah.
And that like this repeat over and over and over with wicked volatility. And then at the end of it, it was net zero. That is a high price of admission, to use Morgan
Yeah.
Housel's terms. So you've got to be prepared for that. And going back to the earlier quote about Buffett's, like if you're not willing to invest at least 10 years, and honestly, the annualized return of stocks doesn't really average or doesn't really get consistent until you go out about 30-year rolling periods. 30 years is a long time. And
Yeah.
most of us do not have that kind of 30-year mindset when we invest. So
Yeah.
it's a challenge.
And they get more consistent in terms of the dispersion in the annualized return getting tighter, but the magnitude of the difference, like if you have a 1% difference in returns over 30 years, the magnitude of the ending difference is massive.
True.
So still
But,
still a lot of volatility even at longer horizons.
mhm.
A lot of volatility in wealth outcomes, even if it's a tighter volatility in or tighter variance in returns. Yeah, so I think framing the risk as the probability of running out of money really does put emphasis on what long-term investors should really be focused on, which is earning sufficient long-term returns to fund their future consumption. And that can mean having to endure the risk. Or I mean, I would say it really does require enduring the risk of higher expected return assets like stocks. Not doing that can really impair your ability to meet your long-term goals. I mean, the Scott Cederberg research on this stuff really kind of drives that point home. Now, even if you have the right focus, and even if you do invest in high expected return assets, kind of like my large variance and wealth outcomes example a second ago, having the right focus doesn't mean you're going to get the outcome that you hoped for. So there's a couple of really good quotes on this too. Carl Richards, who's an author, he wrote The Behavior Gap. He's described risk as what's left over when you think you've thought of everything, which is just such an elegant quote. It really captures the fact that models are not reality. No matter how good we think our models are, the future is unknown and unknowable. And that unknown and unknown future is what actually matters. That's what you care about, but you can't predict it. We don't know what's going to happen. I think theory and long-term evidence can help to kind of point us in the right direction, but they can't predict the future. And that just doesn't just apply to investments. I think life in general has a way of throwing curveballs at you, or curveball in my case, I guess, making it hard to plan. That was a testicle joke. Making
I didn't get that one right away, but all right.
Which makes it hard to plan for everything. I came up with that on the fly. I wasn't planning on saying that. It just came to me. Economist Elroy Dimpson, who I'd love to have on this podcast, he said that risk means more things can happen than will happen. And I think every financial plan has to account for the fact that we simply cannot know the range of future outcomes based on what has happened in the past or based on what we expect to happen in the future. Now, that doesn't mean we need to kind of tiptoe around and hope that nothing bad happens. But I think it does mean that we need to maintain a healthy respect for the fact that things will not always work out the way that we want them to, no matter how much data we base our decisions on.
Yeah, and I think it's an important point, right? Because we do sometimes get questions, from that clients. Well, what if we haven't prepared for all of the things that could come down the pipe? And it's like, we can't prepare for everything. We can prepare for risks that seem reasonable. I do think, though, that it's also worth appreciating that, there is an opportunity cost to trying to prepare for everything. So if you're going to build an ultra conservative portfolio, that would hold up against a risk that is, 1 in 200. Well, it means that 199 times out of 200, you will have made the wrong decision and will have compromised your lifestyle in some way in order to protect against the extreme case. So you need to find a balance. I mean, it's a bit like saying that before anyone gets on a plane, they should be strip searched completely, because that's the only way we can assure that no one brings a bomb on the plane. Probably true, but would shut down air travel to the point where it would be impossible. And, your financial plan could be kind of similarly impaired if you try to protect against every conceivable risk. So there's a balance there somewhere.
Yeah. Yeah, definitely.